Good evening and welcome to our presentation on the Procter and Gamble company valuation. Firstly, I would like to introduce you to the team. The team consists of Brian, Juan, Peter, Brian, and Tomas. Our presentation consists the following. We begin with the company analysis in the household industry. Later on, we will review different valuation methods. Additionally, the market performance will be analyzed, and lastly, we'll review analysis opinions and our own recommendation. On to the company analysis. P&G specializes in customer goods across beauty, grooming, healthcare, fabric and home care, and baby, feminine, family care. Their market position is very strong. They are global leaders in customer goods, operating in over 80 countries with a strong presence in both domestic and international markets. On to the financial overview. As you can see, the sales between 2020 and 2024 have been gradually growing over the years, but the EBITDA and the EBIT haven't been showing much presence. P&G have approximately 108,000 employees, and their net earnings is 14,974. Their global presence is very strong in North America. Secondly comes Europe, and then the rest is between Latin America, China, Asia Pacific, India, Middle East, and Africa.
Next, I will talk about the industry analysis. So P&G produce cosmetics and care. They participate in cosmetics market and also some smaller markets like skincare, hair care, home and lingerie care, adult and baby diapers, and also oral care. And the market that P&G participates in is really large. For example, like the cosmetics market, the market revenue is projected to reach 120 billion US dollars by 2029. And all the markets that P&G participated in, they all have a quite stable growth rate. They all like the growth rate of those markets line between 2.62% to 5.4%. Although the growth rate are stable in long term, however, it still faces some volatility. As you can see, in 2020, the revenue of cosmetics market recorded a decline. It is mainly due to the COVID-19 pandemic. So we can observe that P&G is highly responsive to economic downturns. So let's compare P&G with its peers companies. P&G is definitely a leader. It has the highest revenue. It has a revenue with 18.97 billion. And for the brand name, L'Oreal is the leader in terms of this aspect. But P&G is also one of the most influential company. So P&G has two main brand names. One is Gillette, another one is Pampers. And having a strong brand recognition and revenue position is very important, and it helps to capitalize growth opportunities and in emerging markets and help to expand product lines. So, comparing P&G with its peers companies' performance, P&G is doing quite well when compared to other companies.
Let's talk about the multiple analysis. We are using for comparable companies Unilever, Kimberly-Clark, Church & Dwight, and Colgate-Palmolive because they have a similar capital structure, they share the same business segments, and also they are strong competitors in the industry. For the multiples, we will be using price to sales, price to earnings, EV to EBITDA, and EV to EBIT. We chose these multiples because the growth of sales and earnings and both margins, EBIT and EBITDA, have been pretty consistent throughout the years with small variations, not only for P&G, but for the industry, which has made them pretty valuable and accurate when evaluating the companies. Now, regarding the results, the media fund multiple suggests a slightly overvaluation of the stock because the current price is around 179 US dollar. Well, yes, US dollars. But the implied share price calculated by the mean shows a value per share which is in the ranges that the stock price has been in the past month. And it's also important to notice that the 75th percentile results are aligned to some or most of the analyst expectations. Now, following with the discounted cash flow analysis, here are our main assumptions. First of all, the growth assumptions, which were made by a weighted average growth. This because there are many industries involved, the 5 different segments of P&G However, two of them account for more than 50% of their sales. That's why the growth in these segments has a higher impact in the total sales of the company. And also, it's important to know that the tax rate will be fixed to a 21%, even though P&G has a effective tax rate that is lower than this. It is lower because of many factors that fluctuate throughout the years, which makes this unpredictable. That's why we're using a fixed rate. For the WACC, it is 6.32%. And of course, the free cash flows grow throughout the years, but the discounted cash flows forecasted are lower because of the discount rate, ending up in a sum of discounted cash flows of almost $140,000 million. And using a terminal growth rate of 2.4%, we get an enterprise value of $427,000 million. And taking into account cash, total debt, non-controlling interest, and preferred stock, we end up with an equity value of $402,000 million, which gave us a result of a value per share of $170. This is important because, once again, a slightly overvaluation of the stock is shown. However, this can be due to conservative assumptions, as some of the ranges. But as we did three scenarios, we have that the suggested price or target price, it's around $170, which is similar to the current market value of the share.
I will be going through the residual earnings analysis. We have three different cases for this valuation model: the best case, the base case, and the worst case. So for each of the cases, we have split the time categories into three different parts: 2024 to 2026, 2027 to 2030, and 2031 to 2040. On the left are the assumptions for 2027 to 2040, using the same cost of equity as the DCF, the earnings retention ratio from Yahoo Finance, and the starting book value per share from Yahoo Finance as well. Alongside the return of equity of 25% and 15%, and the EPS and dividend forecast, we're able to get the present value of the residual income. Added with the current book value, this will give us a value of 65.45. However, we still have to add on the terminal value, as given the high return of equity of P&G currently, it is unlikely that there will be zero terminal value for P&G. We have decided to use the exit multiple method, and we'll be using the price to book ratio. The price to book ratio of 7.315 is obtained by using the median of all of its competitors. Multiplying it by the 2040 book value and discounting it to the present value, the terminal value obtained is 150.67. Adding the terminal value and the residual income, we get the implied share price of $216.12. For the best case, the only changes that we have made are to the return of equity, changing it to 30% and 20% instead. This will lead to an increase in residual income for the time periods of 2027 and 2031, leading to an increase in the 2040 book value and an increase in the terminal value. This will lead us to the highest optimistic implied share price of $271.74. For the worst case, however, we have decided to change the return of equity to 15% and 10% respectively. We have also further decided to reduce the price to book ratio. This is done by removing outliers in its competitors and taking the leftover average of the leftover companies instead. Multiplying it by the reduced book value, we get a lower terminal value of 39.34 and an implied share price of $123.85. Thank you.
Next, let's talk about the reverse engineering analysis. And the purpose of the reverse engineering analysis is try to find out the implied growth rate given by the market. The first thing we need to do is to find out the current market price, and the current market price is 178. And next, we'll need to find the book value of the equity, the cost of equity, and the expected earnings per share next year. And the figures are shown on the PowerPoint slide, and we have to plug the numbers into the formula, and we can find out that the growth rate is 3.1%, and we can compare this imply the growth rate with other companies implying the growth rate, such as the peers companies or the whole bunch of stock like the S&P 500 to determine the growth, to determine that whether the stock price is overpriced or underpriced.
Hi, I'm Brian. Today I'm going to introduce you about the market performance of the P&G stocks and the analyst consensus and its opinion. So first, about the market performance of the P&G stocks, you can see from the past 52 weeks total return is about like 20%, and comparing to the S&P 500, it's kind of like a defensive stocks. And it also shown in the 5-year historical data. It's around like 0.4. And here I listed all the important events for the P&G stocks. And the most important and the most recent event is in here. It's in November 21, and it's an investor day. Like the company boosted the market confidence for the company by like showing a better profitability future. Like in the investor day, the management forecast that there will be some profit increase in the North America, Europe, and some emerging markets. And it's estimated about like 33% sure growth in the revenue. And also, like the company also tried to lower their cost via like improving their supply chain efficiency. Like it's estimated to save about like 1.7% of the cost. So yeah, and for the risk of the company, like they the worsening macro conditions in China have posed some threat to the revenue growth of the company. Like it had the declines in the sales in China has already reduced the revenue growth by like 1%. Although the China only contributes about like 7% of the P&G total sales, but it's still an issue. And also there have some inventory problems in the China too. And another thing is that the P&G has announced some business restructure in some Argentina and Nigeria market. So like it's about like 3% potential cost increase in the next year. And analysts view this as a sign of like difficulty faced by the whole industry in the economic downturn. Yes, and here, like although this one is a big growth in the revenue, but the uncertainty is still high. And the uncertainty in the China market futures is also exists. So we have to pay attention to this issue. And here, before talking about the analyst opinions, we have to first discuss about the management opinions about the company's future. So first, in here, you can see that this red line is the sentiment score of the 10K of the P&G in 2020 to 2024. Like you can see here that it has dropped it from like it had dropped it a little bit from 2023 to 2024. And we believe that it has shown the increasing concern from the management to the company's long-term challenges. But however, as I said before, in the most recent investor event, the management showed a high confidence to achieve their long-term growth target. And it successfully convinced the whole market that it will achieve that. So you can see here, they have a large stock price increase. And so, as I said before, analysts is kind of optimistic about the P&G long-term prospect. And you can see from here, the buy analyst, the analysts recommend to buy is like more than the analysts recommend to hold. So it's kind of like more optimistic. But if you look at the mean of the analyst target, it's around like 182, comparing to its current price 180, the room to grow is pretty limited. So although so although it may have some small growth in the future, but yeah, it's just a small growth.
To finish off the football field and our own recommendation. The current price is $179.32, and the 1 year target is $184.64. This is a result of the valuation methods and expectations of the market conditions. This is why we recommend holding, because there is a potential return, but not big enough to recommend buying. One should keep an eye on P&G sales in China and if P&G achieves growth expectations, because that can have either a positive or negative impact. Lastly, you can see our appendix and references, which you may take a look at. And after that, we are very thankful for listening to our presentation, and our team is willing and ready to answer any questions there may be. Thank you very much.